Everyone, welcome back to the Weekend Charts. Charlie Blow here, and with me, once again, by popular demand, Jamie Battmer, Chief Investment Officer at Creative Planning. Jamie, good to have you back. A lot of people were asking for you, and here we go. Just a month later. How you feeling? You ready to go again?
I'm like giving my all, Charlie. I'm like giving my best. Last time it was right before the Super Bowl. I was rocking my beloved Kansas City Chiefs hometown jersey, and that weekend we went on to win the Super Bowl. Not to rub it in, but today I'm wearing my royal blue opening day, Kansas City Royals. So if we end up winning the World Series, I'm taking you with me in Las Vegas.
Done. Let's do it. Yeah, and if you remember, I picked the Chiefs. I'm not going to pick the Royals, but I did pick the Chiefs to win, and so we'll see. I'm a Mets fan, so it's always ends in disappointment. Same thing with the Jets, but we'll
Well,
see what happens. But go ahead.
2015, it definitely ended in disappointment when the Royals beat the Mets, but that's a different podcast for a different day.
Thank you. Yes. So we got a lot to discuss today. We're going to talk about some of the big surprises in Q1. 3 months into the year now. Smooth sailing going on in the equity markets. A little bit of froth, some signs. I want to get your opinion on that. Cocoa is going crazy. I know you have some thoughts there. Housing affordability, big issue for a lot of Americans. We're going to discuss that and what some potential solutions are, what the government is proposing. We're going to end with something positive, as we always do, and that is the power of dollar cost averaging. If you were the world's worst investor, we're going to show you how dollar cost averaging could have actually saved you. So let's start out here. First quarter, I know you do a big quarterly write up, Jamie. You're always asking me for different charts. I never know what you're going to be using them for. I assume some of them will end up going into your commentaries, but biggest surprises of the first quarter. I have to say, number one here, I know you had this on your list, but not a lot of people expected this to be one of the best starts to a year in history. S&P 500 up 10%. First 60 trading days in the last 30 years, only 2019 and 2012 really were better than this year. 1998 as well. I'm just looking at that there, but 10%, pretty strong run first 60 trading days. You're hearing that from a lot of people that this was a surprise.
Yeah, I mean, it's historically almost unprecedented, but it's really just a continuation of that very, very strong momentum we had after the tail end of October last year when kind of hit that full 10% correction. People were saying the sky is falling. Fed pivoted, started to move forward at a really sharp pace, and it just kept going on in the new year. So yeah, it's a surprise. What was anticipated. Anyone that tried to say they could project that, their crystal ball is just as foggy as ours. But we're happy to take it and see that the positive momentum coming out of the difficulty of 2022 with the great rebound in 2023 has been historically great to start 2024. Great surprise.
Right. So the question then, of course, okay, now we've got the 10%. What does that mean for the rest of the year? And that's why I put the data in here. And as you can see, not necessarily, some people might argue, okay, well, 10%, that's too much. We're going to have a pullback, or we should have a pullback. And more often than not, the market keeps going higher into year end, as you can see here. I mean, pretty much every year, with the exception of 1930. Hopefully, doesn't end up like 1930. Pretty much every other year, you had a positive return, even 87, which ran up and up and up until it crashed, obviously, in October. Still finished the year positive. So the expectation should be, I think, by looking at this, continued gains, but obviously a slower pace. Right? If we did 10% a quarter, that would be insane. I don't think that should be the expectation, right?
No, of course not. But what it's showing is, I mean, the trend is your friend, and usually positive momentum is reinforcing for further positive momentum. And
That's
sure,
right.
it's happened before, but unless we hit 25% unemployment like 1930, we're hopefully in a very different dynamic now.
yeah, and the interesting thing for equity markets is if I showed you the worst starts to a year, you'd see something pretty similar in terms of the market tending to rally from there. So I think the overall lesson is don't let short-term returns influence your expectations for the future. But in terms of all-time highs, 21 so far this year. And if this were to continue at the current pace, which is not likely, it would actually exceed the record in 1995, which was 77 all-time highs. Kind of incredible there. And what I tweeted out the other day was that the sum of the all-time highs over the last 12 years is actually more than what we saw leading up to the peak in 2000. So just pretty remarkable 12-year run for the S&P 500 in terms of all-time highs. But strategist forecast, I know, Jamie, you were at 6,000 or above, right, for the end of the year. Clearly, you wouldn't be in the 4,200 camp that JP Morgan was in at the start of the year, but just kind of remarkable here that we're already ahead of every single one of these except for one, except for Yardini. So credit to Yardini at 5,400. We're 8% above the average target, and we're at the end of March here. That's a little bit insane, a little bit of a surprise, certainly to these people. And what I love to see, I don't know if you love to see this, but you see Bank of America coming out, upping their target, this Citigroup upping their target. So they start scrambling. Same thing that they've been doing with NVIDIA. They just keep raising and raising the target. And
Yeah.
then at year end, oh, I hit my target. Yeah, but you raised it 10 times.
Yeah, our 1 year target is the exact same as it is every year, and that we have no idea what's going to happen. And yeah, they keep bumping it up to hit their targets, hit their bonuses. Good for them if their powers that be let them get away with it. But these are the same individuals that Bloomberg polled at the beginning of 2023, and collectively they thought the S&P 500 was going to be down in value. Whereas, lo and behold, they only ended up missing it by a full 30%, with the S&P actually being up over 20%. So these short-term expectations are essentially worthless. And yeah, they keep upping their own targets. Again, but hey, we'd rather have them be upping this instead of reducing lower lows.
Right. That in 2022, as you said, they were way above. They were all expecting pretty good gain that year, and they had to reduce
Yeah.
it throughout the year. But the crazy thing entering the year, and I talked about this with Peter, was that the expectation was so low. It was less than a 2% gain for the S&P 500. So the most bullish thing I could think of today is the fact that they're not predicting 8 to 10% gain like they usually predicting, and especially after a strong year like last year. But number two in terms of big surprises, I think I don't think anyone would have been shocked to see the Magnificent Seven, or as I call them, the Enormous Eight, do well this year after last year. You kind of expect things to continue, and for the most part, they have. But I would say pretty surprising divergence here between the top performer of this group, Nvidia, up 82%, and Tesla and Apple down on the year. Tesla down 28%. So we're not seeing this kind of rising tide lifting all of these big tech companies and big companies that we saw last year. So an interesting thing there. I don't know if there's anything to take away from that, but what's your thoughts on the beginning of a little bit of a divergence here in terms of these big names?
Well, I think it's a healthy thing to see market divergence again, so they're not just all participating in the exact same upward momentum. But again, this is Magnificent Seven, the Enormous Eight. They're even saying now what the Tremendous Two, because Nvidia and Meta, or Nvidia and Facebook or Meta, they're benefiting the most from the most recent wave of AI related excitement. But I mean, it's the Tremendous Two, the Enormous Eight, Magnificent Seven, Fangs, Bricks, the Nifty 50 from the 70s, the dot-com darlings. Usually when they start putting a moniker to these companies is typically when the great part of the returns has already passed. And so for us, how we manage money, it just reinforces the need not to, don't be chasing NVIDIA, don't be chasing Facebook, but don't run from them either. If they're a part of a well-diversified asset allocation strategy, part of the underlying indexes you invest in. And so usually once monikers like this start gaining traction, the rose is off the bloom. But yeah, it's nice to see some divergence there.
Yeah, so you're seeing it as a potential sign, the fact that everyone's talking about it, still is talking about it, of maybe it's past its prime. And if we look at the ratio of, let's say, Apple to the S&P, I think it would surprise a lot of people. Apple was the biggest company in the S&P 500 for a long time now. Microsoft has surpassed it, but most of the relative gains came from the period leading up to 2020. And if we look at the last 4 years now, relative to the S&P 500 after the recent pullback here, it's sideways. So like it's kind of surprising how quickly that can happen now. It feels like, oh, Apple's been outperforming consistently forever, and now we're 4 years into this, and let's fast forward 5 years from now, and what this chart will look like, we don't know, but potentially you could be looking at a period where Apple underperforms the S&P 500, from that period in 2020, 2021. And this was even more interesting to me, Jamie, looking at the NASDAQ 100 relative to the S&P 500, and the fact that we're not hitting new highs today, even though these stocks are still getting all this attention. We're still kind of trading sideways over the last few years. So we had that big move lower in terms of tech underperforming in 2022, and then of course that huge outperformance last year. But if we look at the last 3.5, 4 years, we're kind of gone sideways here. And the question is, we've been waiting for this. I've been talking about this since late 2020, early 2021. And is this a secular change that's about to occur? We don't know, but an only way to protect you in the event that it is you got to diversify in advance.
Yeah, I mean, this is a really interesting chart that would, like you said, catch most people by surprise, but it's just we're so focused on the now, the instant gratification. Yeah, the last year, that was Magnificent Seven, Enormous Eight, whatever we'll call them. Yeah, they did great, but even zoom out 2 years, just like everything else, if you love them now, you should have loved them even more when they were collapsing, relatively speaking, in 2022. And so, yeah, this is really an interesting chart that would probably 9 out of 10 people you pulled on the street would not believe this.
Yeah, and the saying, kind of, the average stock isn't performing, and it's just big tech that's going up. It's simply not true. If we go back to here, go back to that performance here, I'm showing you S&P equal it's up 7% this year. It's still lagging, so still trailing, but certainly not down. The average stock is still doing pretty okay. And if we look at the last few weeks, we'll talk about small caps in a little bit. Small caps starting to perk up a little bit, and I think that might be one of the big surprises for the rest of the year. But we got to talk about the Fed, Jamie. This is what they said in their latest update to their dot plots, to their economic projections. What they said versus December is going to be higher growth this year. We got another increase in GDP today, bumping up in terms of revising higher there. And they said consumer spending was actually better than expected, and government spending is actually boosting that even more than they expected. So it seems that jump from the Fed is going to happen. The Fed was forecasting lower unemployment, so 4.1% down to 4%, higher PCE inflation, core PCE, that's their preferred measure, so 2.4% up to 2.6% for this year, so still well above their 2% target. And yet they decided to leave their projection for the Fed funds rate unchanged, still implying, of course, they don't have to do this, but implying that they're going to cut rates 3 times. And when pressed about it, Powell didn't come out and say, we're not going to do it. He kind of still left it open. But isn't that kind of surprising to see in your mind that they would be expecting higher inflation, higher growth, lower unemployment, but still feel the need to cut rates 3 times this year?
Yeah, I mean, they're trying to, thread a needle pretty specifically, but the data has been supportive of, continuing strength in the economy, like with the updated GDP numbers. That caught everyone by surprise. All these projections, at this time last year, it was expected GDP growth overall was a fraction of what it actually turned out to be. So yeah, for them not to change their projected rate cuts while the data has changed dramatically over that same time period. Um, it does add to your challenge of the Federal Reserve and its place and its role in the markets, Charlie. But luckily, the markets have started to adjust their overall expectations, even though the Fed seems stubborn and not willing to adjust theirs yet.
Yeah, so here on that point, the market was expecting 7 rate cuts coming to the year,
Yeah.
which we had said was kind of ridiculous. Unless we were going to go into a recession, why would they feel the need to cut so quickly, especially with inflation still above 3%? And very quickly here, the market has adjusted, and now it's at pricing in 3 cuts by the end of the year, same as what the Fed is saying. And I guess the surprising part of that would be if you told people that at the end of the first quarter, the Fed and the market were going to be in the same place. Well, wouldn't that be disappointing for equity markets in terms of sentiment and everything else? Well, it doesn't seem to be. Just as the market did fine last year and the Fed hiked a few times, the market doesn't seem to care about interest rates right now. And what we have here is a crazy situation where we have stock markets at all-time highs, home prices at all-time highs, Bitcoin at all-time highs, crypto going crazy again, unemployment rate still below 4%, inflation above 3% for 35 straight months. That's the longest period of high inflation we've seen since the late 1980s, early 1990s. And yet the Fed is still expected to cut 3 times this year, with the first cut coming in June. Does that number 6? To me, that's absolutely ridiculous that the Fed would do that. Things are going well. Inflation, the war against inflation doesn't seem to clearly have been won. What is the urgency in your mind to start cutting interest rates in June?
Yeah, there shouldn't be. I mean, again, let's potentially say, let's call it what it is. Lowering interest rates is stimulus. It's a stimulant to the economy. Why would we continue to see market all-time highs, home price all-time highs? Why not save that ammunition for the inevitable storm that will present itself? And yeah, there's one of these things doesn't match the other, and clearly it's number 6 in their unwillingness to change. I thought it was way unnecessary for the Federal Reserve for Chairman Powell to be so specific in the number of rate cuts they were anticipating when they made this announcement last October. And so maybe because they were so specific at that on the front end, they feel like they have to maintain it, which seems like might be doing it for the wrong reasons. But yes, the data supports a potential change,
So
and the
yeah,
Fed
I want
seems
to stop you
stubborn.
there in terms of the wrong reason. So, like, there's, my view is it could be. Do you think it's the fiscal situation, the fact that interest costs on the debt are now over $1 trillion? Could it be also be because the Fed is now losing money, right? Because they're paying out all this money on short-term interest to banks, and they have these locked-in low rates on their balance sheet. Could any of those things be factoring into this? Because it doesn't seem to be the mandate of maximum employment and stable prices that could be driving this, especially if your target is supposed to be 2% and you're not even there yet. And as I argued last month when we discussed this, you're well above that 2% if you use an average rate of inflation.
Yeah, it's there's a long history of the assumption that there's outside influences really kind of pushing pressure on the Fed. You know, Harry Truman blamed them for stuff. Richard Nixon blamed them for losing his first election to Kennedy. Carter blamed them for losing his reelection bid to Reagan. So it's a bipartisan angle to blame the Federal Reserve, and I also think it's kind of a bipartisan angle that these outside pressures create additional impact on them. I do think these men and women do take their autonomous dynamic seriously. I do not agree with their ability to make exorbitant speaking fees as soon as they step down. That seems to be like the standard operating procedure for making a profit off of this very powerful position. But
From the
I
from the
do,
companies that they're supposed to have regulated right before
yeah,
that.
exactly. And so yeah, it's probably there are these outside pressures, but I personally think it's more of them wanting to stick to what they prescribed last fall, even if the fever symptoms have been slightly modified.
Yeah, I'm kind of in that view for a different reason. Like, I don't think it's necessarily the fiscal thing or the Fed, the fact that they're losing money. I think it's their obstinance in preferring this easing bias, which it makes sense when you think about it. Why wouldn't they? It's the same reason why the government prefers to run deficits, right? That's like, not on my watch are you going to have this problem. Well, they're going to prefer easing because that'll keep things going longer, right? They want stocks doing well. They want home prices going up. They want all of these things. Why have that extra focus on inflation when you can have all of this, what Bernanke called, right, the wealth effect? And so my view is they don't care about as much about inflation as they say they do. And I think if they end up cutting rates in June, it'll be kind of solidifying in people's minds that the so-called sticking to it and holding the line until the job is done. Well, that simply, you can't say that's the case if you're going to cut in June and we're still nowhere near 2%, which I don't even think should be the target. So we'll see what happens. I don't think it's set in stone. I think we could be coming back in a few months and say, okay, the expectations were pushed back. I think they're going to have a hard time after the March CPI report. It's going to probably bump up to around 3.4%, and they're going to have to make the case that that was a one-off, that it's going to come back down, that, as we know, the shelter component's going to continue to go lower. They're going to have to make that case, and hopefully they're right about it. But I think the last thing Powell wants is to have to reverse course, right? Once he cuts. So I think in his mind, he has to be pretty confident it's going to continue to trend lower for them to get started. I just think it's a kind of a crazy thing to do it when everything is going so well. And we've only had restrictive policy in place for a short period of time here. So
You know,
we'll see what the Fed ends up doing. We could
I
we could go a whole nother hour on this, Jamie, but go ahead.
100% agree. It'd be a shame if the data changes, yet they don't change to respect the modifications in data. I mentioned a lot of presidents that blame the Fed. I don't even put you in any of those camps. I put you in that true Andrew Jackson camp of, he actually blew up the Fed. So I feel like you adhere to a Jacksonian policy, Charlie,
No
more than
question.
others I referenced.
I would remove both mandates. They can keep their regulation of the banks, but they should not be setting interest rates for the largest economy in the world. They're going to get it wrong again, either by cutting too soon or cutting too late, because they're human beings, and it's impossible to know where that rate should be. That's my overall objective. But if I'm going to pick one mandate, it would definitely be inflation versus employment, because I don't want the Fed figuring out what the right unemployment rate is. I think that's just a crazy notion to have this group of 10 people saying this is what it should be. Like, that's absolutely insane. And they haven't been able to prevent recessions over the past 50 years. They certainly didn't prevent the Great Depression. They certainly probably exacerbated it. So why do we think they're going to get it right this time? Not likely to happen. Okay, I want to move on to biggest surprises from here, Jamie, in your view. Small cap outperformance, international outperformance. These are all things people have been waiting for years. Still underperforming. Nvidia, will they finally miss expectations? Hasn't happened yet. Will that happen? Fed doesn't cut rates, as we talked about. That would certainly, I think, be a surprise if they didn't cut rates at all this year. And volatility, which we'll talk about in a little bit, haven't seen much of it. If we were to see a VIX spike above 30, I think that would be a shock. But more likely, in my view, it's probably something not on this list at all. That's something which always seems to happen that we're not thinking about.
Yeah, I have to follow your lead. It's usually something unknown. Would anyone have called the, you know, pandemic, the pending doom? A couple of years ago, would anyone been talking about the excitement around artificial intelligence, or a couple of years before the dot-com bubble, the excitement of that? So it's usually not, what you're building your fortifications to defend against is usually not what ends up creating the problem. So the names are always different, but the problem's always the exact same: spiked volatility, uncertainty. People unfortunately make the exact wrong decisions at the exact wrong time. I think, if any of these that are naming there, I think hopefully it would, to reinforce the Federal Reserve deciding not to cut interest rates and cause that hopefully means the economy is continuing to chug along. Yes, inflation might stay a little bit elevated, but I think we're still in a pretty decent spot. We're so far off the peak of near 10% inflation rates, yeah, kind of that 2-3% range. So I think we're close to there. Hopefully the Fed doesn't cut rates, and it means the economy is continuing to chug along. It means the markets are continuing to chug along. So of all the known unknowns, that would be the one I'd be hoping for.
Yeah, a great point there. I think if they ended up cutting rates more than three times, let's say they cut six times or eight times, that's going to mean the economy is in a pretty bad place, right? Between
Yeah.
now and then. And we saw that in 2020. We saw that back in 2007 and 2009 with the aggressive rate cuts, and also during and after the 2001 recession. So that this notion that rate cuts are always a good thing, you have to be careful what you wish for, because yes, it could be the Goldilocks scenario, and that's what we're hoping for, where everything is good and the Fed's just cutting because they have room to cut. But there's also the possibility that they're being forced to cut because they do then have to stimulate. We definitely don't want to see that. Okay, it'll be interesting to see which one of these ends up being a big surprise, but we got to move on to talk about the smoothness of the ride higher. So 10% returns, as we said, pretty unusual, but I think the way it achieved it, the way it got there, Jamie, more surprising. If we look at the VIX average so far this year, 13.7, historical average is 19 and a half. The year's obviously not over, but if it were to end here, it would be the lowest VIX on average since 2017, which was, of course, the year where it just S&P 500 went up every single month that year, and it was just very, very low volatility. And here's probably the more amazing fact. If you've been waiting for a correction, waiting for a pullback to get invested this year, there simply hasn't been that opportunity. The biggest drawdown on a closing basis for the S&P 500, 1.7%. And if the year ended today, that would be a record. 2.5% drawdown is the current record in 1995. 2017 came close at 2.8%, but kind of remarkable the ease in which we've achieved this 10% gain. Very, very unusual that you don't have to pay the price of that return, right?
Yeah. I mean, I think there's a higher chance of the Royals winning the World Series. That's not getting more volatility at some point. The remaining, the remaining 9 months and 17 minutes of stock market activity. But yeah, I mean, it just has to reinforce it, regardless of if it's smooth sailing or choppy like a seismograph. You just got to stick with it because this can be overcome in an instant. What was relatively hunky dory to start 2020. How quickly did that change just 90 days later? And regardless of what the VIX is telling us, it just reinforces that don't fear when things are great, and but if volatility presents itself, use it to your advantage. But it's a necessary byproduct of the markets, and it's great that it's so low, but it'll definitely ramp up at some point.
If you're a betting man, you would say that the average year has around three corrections or three pullbacks of 5% or more. So it could happen, right? There's 1995 and 1990 and 2017, but that's abnormally low, just as 2008 drawdown, you could see there 48.8% was abnormally high. If you have to pick between the two and you're a long-term investor, you want the bigger drawdown. That's the great, like, it feels great that everything's calm. All the news has been pretty good related to markets this year. But in terms of opportunity, the real opportunity is going to come when you're seeing these big numbers.
Yeah, and when it inevitably ramps up, our communication to our clients is unfortunately going to be the same. We see a lot of money flowing out, just like we saw in October. Huge money flowing out of equities, going into cash, going into bonds. No, unfortunately, please don't follow the same flawed siren song when inevitably volatility presents itself, and use it to your advantage. Or more so, even if you can't do that, just stay the course. But that's what we sent out at the end of October when the flows into cash were pronounced. the exact wrong moment. And I can tell you right now, that would be what we'd be communicating to our clients the next time that 10% downturn occurs. It'll probably happen this year. It's supposed to. If it doesn't, great. But you can almost pre-write that communication that we put into our clients, because the historical data only further supports not making those emotional decisions, no matter what.
And would you say the run up we've seen over the past few months for some people, I guess it's a portfolio specific question, but rebalancing works both ways. We know the real huge rebalancing opportunity is when stocks go down hard, right? But obviously we're not in that situation today. So the question would be, particularly for risk averse investors, they've seen a huge run up in the equity portion of their portfolio. Is it enough to warrant saying taking some of
So
those chips off the table?
absolutely. Again, rebalance needs to be prescriptive and methodical. Do it in the worst of times and in the best of times. And even another element to that, speaking of how we manage money, we rebalanced earlier on this year because we did crest back to all-time highs. But even being more methodical and more tactical than that, making sure clients are withdrawing money when there are these big drawdowns. Again, make sure you're taking that money from the bonds. Why? Because you're giving the stock more time to recover, which it always has 100% of the time. So rebalancing on both sides is great, but even being more specific in how you're looking at it, how you're managing withdrawals, deposits is a key part of how we manage money. And it's been proven beneficial time and time again. And it was just proven again beneficial at the beginning of this year. And we undertook that exercise on behalf of our clients where it made sense.
Awesome. So we got to talk about froth, and I don't know if you have the Soros kind of feeling where I think you used to get back pain, or you get this kind of feeling that something is awry here. I certainly got this feeling in early 2021 when we had the SPAC mania, the meme stock mania. We had IPOs pricing every day. It was just everywhere you look, signs of froth. I don't think we're at that point today, but there's a few things that are kind of getting my attention saying, hey, people are getting pretty excited again. I'm starting to see this kind of gambling type of mentality come back, Jamie, quicker than I thought it would following 2022. A pretty difficult market, right? But it always amazes me how how quickly it could come back, particularly when you have the advances like we've seen in Nvidia and Bitcoin and other things, right? It just gets people excited again. And this week, of course, we have Truth Social going public through the SPAC merger, symbol DJT, of course, and the new company's called Trump Media. What got my attention is not that it went public, but that it went public and very quickly spiked to a market cap of $10 billion, which when we're talking about things like Nvidia and Apple, it seems like almost nothing. But why that got my attention is looking at the monthly active users are a million, and they only have 3 million in revenue, and I think they lost $50 million last year. And Reddit just went public, so we have a kind of a comp in the social media space. They have 70 million daily active users, 800 million in revenue. So if we looked at a price to sales ratio, which is of course ridiculous, but have to do this because it's just so unbelievable. You're looking at over 2,000 times sales for Trump Media, and Reddit certainly not cheap compared to other social media companies at 13 times sales. What do you make? Am I making too much of this, or does this seem like the investors, at least in this area, are getting very excited about something that hasn't yet proven itself in terms of revenue and profits? And maybe that's an indication that sentiment overall is starting to get a little frothy again.
Well, there's always got to be something that's going to get people irrationally excited. And, we are in an election year, hotly contested elections, and this is attached to it. So, kind of just further juicing the emotions that are, a blessing of the democracy in which we live in. And so, yeah, at the end of the day, the momentum benefits things in the short run, but over the long run, the fundamentals of prudent business management, the fundamentals of valuations take over. So yeah, it's Froth, but and yes, it happens to be attached to a political dynamic to things, but it's things being overvalued relative to what they're actually making is as old as markets itself. Some of those, a Dutch tulip wasn't worth what people were willing to pay for it for a certain amount of time there in the 17th century. And so these things are old as markets themselves. It's just the additional political dynamic that throws a little bit more of a spotlight on it. But yeah, valuations. Politics just serves no business in prudent portfolio management, and that's an agnostic saying, regardless of someone being happen to be a Democrat or a Republican, and usually when you mix the two or make decisions based upon political leanings, the historical empirical data says that's usually not an effective mechanism for making investment decisions.
And this year would be a great example, right? We're already up 10%. That's actually the average return for an election year, for a presidential election year. And so if you sold coming into this year because you're worried about the volatility, once again, you would have been wrong. But I guess what you're saying here is that potentially people are betting on this because they have a political leaning or view, and perhaps let's say Trump is reelected and this app gains traction, they're going to have to do a lot more than a million monthly active users. They're going to have to ramp that up a lot, but perhaps people are betting that they'll be able to monetize that if they're able to get it. But to me, this is a sign of expecting really best case scenario from here in terms of this company, and more likely we come back in a month and you and I were talking about it, my best guess would be it's going to have a much lower valuation. This is just a sign of exuberance. But it's not just Trump media. We got Dogecoin here back in the news for the first time probably since it peaked a few years ago when Musk went on SNL joking about it. But this to me, whenever you start to get to these periphery coins and there's excitement around that, so it's not just Bitcoin, it's not just Ethereum, the two biggest ones. It's things like Dogecoin, which has no limit on its supply. It's a meme coin. And obviously, people are getting excited because it's going up very rapidly here in a short period of time. That has my attention as well. And then we have things like sentiment polls. We look at investors' intelligence, highest percentage of bulls since 2021. We have active managers, they're leveraged long again. And this has pushed the return, at least strong return in a short period of time, has pushed S&P 500's valuation up to 24 times earnings. Not hugely extreme, but 30% above, let's say, the historical median going back to 1988. Any of this a red flag in your view? Sentiment, valuations, anything worrisome in your mind to say this is perhaps going to be a more difficult juncture going forward?
It just comes with the territory. And, like you said, it's elevated, but not at extreme territory. And could we see a 10% correction and takes care of some of this for us? Yes. Is 10% correction using history as our guide occurring within the next year? Yes. And so maybe that solves some of it itself. I do think it's interesting, again, for your prior charts. We always talk about letting we never know if valuations can continue to expand. Artificial intelligence is really going to take things off, but it's always interesting. We mentioned it where people, the bullish sentiment and why so few people were actually bullish, relatively speaking, after the downturn of 2022, because the historical empirical data, we weren't bullish, but we said, hey, the historical empirical data says after a downturn like this, the most likely next step is a movement back higher. And so that's always what I have problems understanding. People actually not using history as their guide to make more informed long-term decisions. Yes, you never know year to year, but after a major downturn year like that, the data would say the next year is going to be positive, and why so few relative investors actually were at that rate. That's actually the surprising thing to me.
So you're saying 25% bulls near the bottom in October 2022, 61% bulls today. You have the S&P 500 44% higher today. Like that shouldn't make much sense that you would be more bullish at higher prices, higher valuations. But we're human beings. We're not machines that are making optimal decisions. I think this is the best example of why you need a plan, why you shouldn't be using some discretion in terms of, oh, things are bad, I should have a lower allocation. Things are good today, I should have a higher allocation. Like that, in the long run, you shouldn't trust yourself because as human beings, I'm a weird animal in that I get much more bullish when everyone's bearish, and I have that contrarian bent. And I probably have the problem on the opposite end. When everyone's bullish, I probably get way too skeptical. But most people don't think like that. Most people, when everything's bad around them, like October 2008, like it's hard to see a path to recovery, a path to better things.
Yeah, it sounds simple, but all the data supports that most people don't adhere to it. Even the professional investors, the so-called smart money that I think is very mismonitored itself, and the data would necessarily support that. But yeah, essentially be fearful when others are greedy, and only be greedy when others are fearful. I think another wise investor said that, like you, Charlie.
For sure. And but what I always say is it's much easier and better to be greedy when others are fearful. The hard part about being fearful when others are greedy is that greed can persist for much, much longer, and good times can last for much, much longer. So you have to have just a number of signs that this is an absolute mania for you to actually take action based on that. So be much more careful in terms of identifying greed. And that's what I'm trying to do here, is kind of compiling one after another here. And things kind of stack up. It's not just one thing, but a number of things that are showing that, okay, that gets more of my attention, just one thing. But finalizing the PE discussion here, I think this is an important point I like to always make. You never should look at a PE on just a 1 year basis. It might mean something, more often it doesn't. And the reason for that is during recessions, the earnings part, the denominator goes down. So it can make stocks look very expensive when they're actually at their cheapest level. And we saw that back in 2009 when clearly uh, stocks are not cheaper than they were back in 2009. But if you just looked at a trailing 12-month P ratio, that's what it showed. And that doesn't make any sense, which is why if you're going to use something, you should be using something that smooths earnings. The CAPE ratio is probably the best thing we have. And there too, Jamie, it's certainly elevated, but not back to where we were at the 2021 peak, and certainly not back to 2000 levels. So as you said, the hard part about valuations is it could continue to go up, right, for a long period of time. And we don't know what that future valuation, what we know in the US equity market is now it's been 30 years of rising average valuations. So that brings up an important question. We'll save that debate for another time. Are these composition of the companies changing? Is it warranting a higher valuation because we have more tech influence with higher profit margins, et cetera, et cetera? We won't have that debate today, but that's an interesting discussion for another time. I want to go for Cuckoo, for Cocoa. Jamie, I know you grew up on Cocoa Puffs, and the cereal era was big in the 90s. We had commercials. I don't think there's commercials at all for cereal, but back then you had a million different commercials, from Lucky Charms, Cocoa Puffs, Cinnamon Toast Crunch. You had everything uh, for the cereal. And the funny thing is, if you go back to these commercials, they were telling you how this is part of a good breakfast for
Right?
you. This is good for you.
Part of this complete breakfast, but it also had like 4 oranges and a bunch of oatmeal in the background as well. So yeah, the
Yeah,
pure sugar that we were fed as children.
absolutely. So thankfully, we've learned. Well, the cereal is still there, but we've learned that's probably not as good for you as eating something like an egg, which it's unbelievable to think. But back then, they were saying that was bad for you. Okay, why are we talking about cocoa? Well, parabolic moves. This is kind of one for the ages here. Looking at the price of cocoa, it's more than tripling over the last year. It's already doubled this year, up and up and up. But why is it going up? Well, It's always supply and demand with commodities. Supply has been cut significantly because most of the cocoa comes from West Africa. They had a number of climate issues, too much rain and now too little rain, tightened supply. And when you have that situation and demand is still there, prices have to go up. And what is this doing? You got Easter coming up, of course. Well, chocolate prices are going up, in my view, not that much, 15%. But I think the chocolate that's going to come out next year, I guess, would be more reflective of today's prices. So you're probably going to see even higher, much higher prices next year. But any thoughts on cocoa? My thought, Jamie, and I've talked about this with the prices of eggs, and everyone was going crazy saying, like, should we raise chickens? I thought if I had to bet a year from now, it's going to be way lower. The market is going to figure it out. Hopefully, the weather situation will right itself. And cocoa's not a good that you need, so you can not buy it, right? So it's not as essential as something like eggs and bread and milk. This is something that, yeah, people like chocolate, I don't, but they don't necessarily need it. So I could see demand coming down as being part of the prices coming down, and supply eventually will right itself. Am I missing something here?
I think some people would refer to chocolate as a necessary part of their diet, Charlie. But coming from someone who grew up on a farm that had a chicken coop on it, that can be a wet hot mess. So think before you start raising your own chickens. But yeah, exactly. Everyone talked about it on the run up when it inevitably corrected itself. The headlines were no longer there because it didn't get people excited because it wasn't something that people could complain about. You know, you hear about bacon going up, you don't hear about it when it comes back down. Same thing will be here. It's weather related. Yeah, as you said, the vast majority of this comes out of a very specific part of Africa, and so it's spiking now. It's great to talk about it. With Cadbury cream filled chocolate eggs and chocolate bunnies coming up here, but the assumption is there'll be a reversion to the mean, and
Yeah,
some cocoa traders will probably profit off of shorting cocoa prices.
I would, yeah, I would. I was just thinking that it was interesting. They just before this run up, they had actually had an ETF that tracked cocoa, and I guess it didn't have enough assets or volume. And right before the spike, literally they delisted it, which is just an unbelievable timing in that respect.
Yeah.
But yeah, if I'm betting a year from now, we'll see. Of course, it's probably going to go to 20,000, but I'm guessing it's going to be probably cut in half over the next year. So we'll revisit that. Hold me to that, Jamie, if that doesn't happen. That prediction that cocoa will come crashing down. Okay, got to talk about housing. This is a big topic for a lot of people, of course, because what's the number one thing people spend money on? Their house, biggest component of CPI by far. It's over a third of the index. And unfortunately, housing affordability has gotten much worse over the last few years. Here's just a visual of the median payment you would need to afford the median asking price for sale. Hit another record high this week at over 2,700. This was at 1,500 in 2020. So you're looking at over 80% increase in 4 years. And here's the problem: like, household incomes have gone up over the past few years a lot, way more than the previous few due to higher inflation. It's great that they've gone up. The problem is that the money that you need to afford that home is much higher than the median household income. And that's what's caused a collapse in terms of demand. And now we have this big gap, and the housing market's kind of in a standstill. So many different theories on how to solve the affordability problem. And the government just put this out. President Biden's proposing one way to do it is through giving a tax credit for first time home buyers. This sounds familiar. I think we tried this also in 2009. So we're saying 5,000 a year for 2 years. Also talking about giving a 1 year tax credit of up to $10,000 to families who sell their starter home. So the idea is that people who are locked into these low interest rates, well, they're not moving because they want to keep that low interest rate, even if they need a bigger house. So help them out by giving them some money. And then they're saying down payment assistance for first generation homeowners up to 25,000, pretty big number there, and down payment assistance for first time home buyers whose families haven't benefited from the generational wealth building associated with home ownership. Um, is this a solution, Jamie? You could probably guess my opinion, but do you think you solve affordability by essentially just giving people the money so that they can afford it?
Unfortunately, no. I feel like it actually exacerbates the problem because it would just flood more money towards these houses. So in turn, making it more expensive. A lot of things like with higher education, not really getting at the root of the problem. It just the prices are going up too much. I do want to look for ways, and the concept behind this does make sense. I don't think they're going at it the right way, but home ownership is just such a powerful mechanism of building wealth. And really, for your average American, they have money in their 401k, they have money in their house, and that's it. And really, it's just because it's a forced savings mechanism. That's a beauty about even when people say the markets are going terrible. Well, I wouldn't be investing in stock market now if my life depended on. Well, you probably still are. It's just in your 401k and it's happening automatically. So you don't think about it. It's the exact same way with building equity in a house and all the kind of the additional responsibilities that come with home ownership, things that you have to kind of take life a little bit more seriously that can have a net positive. So love figuring out ways to make more people homeowners is great, but just giving out more free money would just actually put more capital at the exact same problem and actually make housing a lot more unaffordable because it'll just go up more to offset that difference, in my opinion.
Yeah, that seems to be the case. If you look at the three areas that have had the highest inflation in the past 30 years, it's been housing, it's been healthcare, it's been education. And what do those three things have in common? They're the three areas of the economy most influenced by the government actions, right? So I can't think of a better way if you want home prices to skyrocket from here. I can't think of a better way to do it than doing these programs in mass, right? It's just it comes back to the inflationary problem that we were talking about over the past few years, and the response to that in certain states. California now has done it a few times, where they said there's so much inflation, Jamie, that we need to do another round of stimulus because people can't afford these higher prices. And if you just take a step back and think about that, well, what was the cause of the original inflation? It was giving people money. We borrowed it, right? We didn't tax people to give the people money. We borrowed it and we gave it out. That caused higher prices. And we didn't learn a thing from that because our response to that is let's do some more. And then let's do some more. And now they're doing minimum wage stuff. They just jumped things to $20 an hour there in California. And the net effect is it becomes more and more problematic the more you continue to do this. Now, the good news is I don't think this is going to pass. This is like a wish list, but I don't think any of this goes through. Obviously, they don't have the votes. Depending how the November election shakes out, maybe they will after that. But it's it's a good goal to have, as you say, but I'm not sure this is the way to do it. Ironically, if they eliminated the government influence, I think you would actually see lower home prices. If you took away things like the mortgage interest deduction, which is like nobody wants to talk about that or do that, that would be actually beneficial. If you made it harder for people to buy a home in terms of putting in limits in terms of you can't buy a home with 1 or 2% down. If you took away Fannie Mae and Freddie Mac and their big subsidization of the housing market, if you took out the Federal Reserve and you didn't have them buying up all of those mortgages in 2020 and 2021, driving interest rates so low, prices wouldn't be as high today. So the ironic thing is that was a big part of the cause for the spike, but the solution to the problem was the problem itself.
Yeah, yeah, but the idea of getting more people to benefit from home ownership is a very sound policy, but they are missing the mark this and unfortunately probably having the exact opposite of the intended effect.
Yeah, so we could go on here, but I'm not going to do it because none of this is going to be passed, but it will be fascinating, Jamie, and I think this might be starting to happen actually, is if mortgage rates come down, you might actually see more supply come out into the market, and that might be helpful in terms of pricing. And kind of the opposite of what we've seen, which nobody expected interest rates to go from 3% to 8% and prices to continue to go up. And maybe we're going to see the opposite if rates come down. So I don't know. It's, yeah, anything that wouldn't shock me given what's gone on in the housing market, but certainly it's not a good thing. I think we could all agree it's not a good thing to have prices so unaffordable and having people reach so much to buy a home that they're spending 40-50% of their income on a house. That's not a good thing. So it does come back, talking about cocoa, to supply, and the home builders, they're making profits left and right. So my expectation is they're going to build a lot more homes in the next few years. You're going to see a lot more people coming into that market because their profitability has gone way up, and we have a deficit of homes, right, for sale. And that's why apartment prices, if we look at rents, haven't gone up very much compared to home prices over the past few years, because we have way more supply in terms of multifamily. You have way more vacancies there. It's the exact opposite in the home ownership market. We simply need more supply, and I think if that happens, that'll be a good thing. But let the market do it. Like, I don't want to see a CHIPS Act for the housing market. I don't want to see what China did here, where they're building. How many was it, Jamie? I know you've read a lot about this. China, they built maybe 50 million more apartments or something. I heard some crazy number then they actually needed, and now those buildings are all just sitting there vacant. Like that, we don't want that for sure.
Yeah, when you're building a city the size of Pittsburgh every week for a while, sometimes eventually the laws of supply and demand catch up. So yeah, we don't want to get ahead of ourselves, but yeah, unfortunately, yeah, it is a shame that people aren't affording houses. Also, people are less mobile than they used to be, which is kind of counterintuitive with the ability from a technological standpoint, more opportunities to work remotely. And there are still great areas of affordability, but interestingly, the mobility of your average American has declined pretty dramatically, I believe, over the last 50, 60 years. And even though at the same time, as mentioned, technology's allowed that ability. So um, yeah, it's a valiant effort, but they're gonna exacerbate the problem if in this current form it goes through.
It's tempting to throw money at things. I understand it completely. It's tempting, and it's a band-aid on the problem. It doesn't fix the actual problem. Okay, we have to end with something positive, as we always do. And Jamie, this is coming from you. You had asked me about March 2000 to send you some charts about S&P 500. What if you bought in at the peak in March 2000? How would you have fared if you held to today? March 2000 being the peak where stock market S&P 500 went down over 50% from that peak to its low in October 2002. And here we are 24 years later. If you had held on, you're actually up 5x, 7.3% annualized. MSCI World, they're not as great, 6.1%. Certainly, U.S. has outperformed international, with bulk of that outperformance coming in the last decade. But if you had $10,000 invested back then, you're talking about 5 times higher, over 50,000 today. And here's what you had asked me, Jamie. You said, "Well, what if instead most people aren't putting in a lump sum?" We always talk about this lump sum concept, like, "Oh, how have you done over the last 10 years? What if you bought at this price?" And the reality is, for most people that are working, they're not retired, and even retiring, they're not buying all in at that point, right? They're already invested. But what if you were just buying in, let's say, every year from that peak? You bought originally at the peak in March 2000, but then you continued to buy as it went down. How would you have fared versus just that buy and hold return? And incredible result here, right? Was this surprising to you?
Yeah, again, I appreciate you put it together. I stole it in its perfect form, and it's going out to all of our clients here in about 12 hours. That it just reinforces how we've always managed money. And that, let's say you just perfectly poorly timed the market, but stuck with it and continued to contribute. even if you couldn't have more perfectly missed it, just luck couldn't have been more not shining on you. You're still getting somewhere between almost a 7 or 11% annualized return. It just has to reinforce the mandate to keep calm and carry on. And it was actually surprising that the return was so high. I was not expecting more than double digits. Um, but it just, you know, luck is not a part of it. Luck matters in the short run, but over the long run, it's about being methodical, repeatable, sticking to it, optimizing taxes, optimizing the asset location. That's not even factored into these returns that can add another 1, 2% after tax, but just reinforces even if you couldn't have less luck of the Irish on your side. You're still fine as long as you stay the course. And that was, really appreciate you highlighting that. And that's what we're reinforcing our clients. You say, well, we might be on the crest of a new .com bubble. That's what we're seeing with AI, all this artificial intelligence. Well, it was only 20 years ago there was something just like that people were talking about. And even if that same thing occurred again, as long as you have the ability to stick with it, you're gonna still have great returns.
It should be comforting, I think, right, to see this, and it's not comforting when you're living through it, right? Believe me,
Yeah,
like that first buy in the dollar cost average, if you bought a year later in 2001, you're down, and then you're going to be down again the year after that, and you're like, oh, maybe I shouldn't keep doing this because I'm buying more, but I keep losing more, right? Until that
yeah,
ultimate low, you don't see the benefits, right, of reducing that, overall cost basis, right? And it's just the
yeah,
concept is all about, well, I have 20, 30 years. And if I have 20, 30 years, I have to believe that things will recover. And so, as we showed in the valuation charts, I don't think we're at a March 2000 moment, but we're not cheap either. And none of us can predict, what the next bear market, when it'll happen, how deep it will be. But what we can say, when it comes, if you have the ability to add more, right? This is just looking at an averaging, but certainly if you're able to accelerate your contributions during that period of time, we had talked about that in 2022. I talked about that a lot. You know, don't wait. Take advantage of that decline when it comes. So good news
yeah.
for investors. I'm looking forward to seeing that letter, Jamie. Can I link that or no? That's not publicly. That's just for creative clients or.
We'll let compliance opine on that. I don't want to speak above my pay grade, but Charlie, it is appreciated. And one thing to highlight here, perfectly poor timing. The risk of that is even accelerate, especially if you've just gone through a major change in your life, like you've retired recently. And take this, just remember, this slide could say, okay, retirement's not the end. You've still got 20 plus years, hopefully, and so it will recover. But it's extra frightening when you're not seeing the paychecks come anymore and you're seeing your account balance go down. That makes it even more important to keep calm and carry on and not jump off the roller coaster at the lowest point. I actually was able to experience this after working for almost 10 years. I was lucky enough to complete my master's over at London School of Economics, and it happened to coincide right with a major market dislocation. And so it was frightening. Actually, my wife, who came over and supported me, she hadn't started working yet. She hadn't joined me, and it was actually scary. And I was a young person. I had 60 years left, but only seeing that go one way, I was able to experience how much more frightening that can be, where you don't have that ballast of the additional income coming in. So for your retiree, you've still got a very long time period. This data set absolutely works for you, but it's just that much harder and that much more necessary to not fall to the siren song of fear driving decision making, and that's what we're here to help
Yeah,
people
you
make
need
more
that
informed
balance.
decisions. That's key.
You can't have that FOMO that a lot of
Yep.
people are starting to get back into today. And yeah, I think that'll be a good topic for the next time you're on, in terms of the retirees. Their biggest fear, right, is running out of money. but a simple 50-50 portfolio, even through the Great Depression, for most people that they would have gotten through. And the key there is they would have to rebalance during that drawdown, right? And as a retiree, that's probably more difficult, but it's absolutely necessary, because if you're going to be taking money from bonds, putting to the stocks, the time to do it is when things are down. And of course, things have to recover. You have to believe that the future is going to be better than it is today. So especially true when all the news is bad. So today, all the news is good. We're going to end on that note. We want everyone to have a great weekend. Happy Easter for everyone that's celebrating. Thank you, Jamie. Hopefully the algo that liked you the last time will like you as much. Last time Jamie was on was our biggest show ever. So hopefully we're going to break that record. And thank you again, Jamie. And we'll see everyone next time on the Weekend Charts.
Yeah, thanks, Charlie. Thanks, everyone.